EIS, the Enterprise Investment Scheme, was launched in 1994 by the government to encourage investment into smaller, higher risk companies. In return for the increased risk comes tax advantages, all very good for tax efficient investing. We're speaking now to Charles Owen, the founder and director of Co-Investor, a firm which facilitates access to the Enterprise Investment Scheme. Charles, welcome. First of all, how does the EIS work in more detail?
It's very simple, and there are lots of benefits around, but the government put it in place in 1994 and it's been going ever since. And the reason they did it is because they're trying to encourage investment into UK early stage businesses, because of course that brings lots of benefits to the UK economy. And it works by providing tax advantages to sophisticated investors who invest in these companies.
Does anyone qualify for this? Can anybody apply for access to the scheme?
Yes, any UK investor can apply. It actually relates to the company itself, so the company has to be qualifying. And most unlisted companies are qualifying. They have to get that approval from HMRC. Generally, they'll qualify unless they're agricultural or one or two other things which already get other benefits.
And what is the profile at the moment of the sort of person that applies?
For the company or the investor?
For the investor.
Sophisticated. So we're generally talking at people who already have an investment portfolio. Most of that will be balanced in equities, bonds or ETF structures or whatever it may be. And they're seeking to add an element of that portfolio for other reasons. They might be seeking non-correlated capital growth. They might be seeking tax advantages. There are various reasons, but they will be sophisticated investors.
Let's pick up on that point about tax advantages. What are they within the EIS? What's the attraction?
Quite a lot. So there are a number of them, so let me just list them. So if you are investing, you will immediately get a 30% income tax relief. If you are investing with a capital gain, that capital gain is deferred. If you exit your investment and create a capital gain on exit, there is no capital gains tax. And equally important, particularly with our sort of ageing demographic in this country, there are inheritance tax benefits. And so after 2 years, any investment in an EIS qualifying company falls outside of your estate for inheritance tax purposes.
And losses easily offset?
Like any investment in an unlisted company, if you make a loss, you can claim loss relief on it. So when you actually calculate that, if you're putting £100 in, you're getting your income tax relief. If for whatever reason you have to claim back loss, your net exposure on going into investment is actually quite small.
How does one choose? This is quite an opaque market, isn't it? How does one choose investments in this space?
It's very difficult. Unlike the stock market, there isn't a site you can go to where every company is listed. You're dealing with lots of relatively small unlisted companies, and so finding access to the right ones is difficult. Lots of investors typically find them through business angel groups, or they find them from recommendations from their accountant or their lawyer. But the trouble with that is that it's difficult to know what you're investing into, and how do you know who the managers are? How do you know you can conduct the right due diligence? How do you know what their track record is? How are you going to manage it post-investment? It's very difficult for small investors to get into these things and to know they're making the right decisions, selecting the right company, and know their investment will be well managed.
What about the costs of getting into it?
So typically there are two ways into it. You can go in via a fund, and there are lots of very established fund managers. They manage portfolios for you, so you commit your money to be managed by that fund manager. They will charge you going in, typically 1 to 2% an initial fee, and that's to manage the process. They will charge you an annual management fee, probably around 1 to 1.5%, it varies, and they will charge a performance fee on exit above a hurdle. So when you've got your capital and perhaps a gain back, then they'll seek to take maybe up to 20% on top as well.
What about the amount of time to hold these investments? I know when you're investing in these companies, they want to ensure that they have the money there available for their own internal purposes for a specified amount of time. How long do you commit yourself when you're buying into this sort of investment?
So these, by their definition, are illiquid, and you have to understand that this is a high risk, in FCA terms, this is a high risk investment, which is why it's much more appropriate for sophisticated investors than general retail investors. Because they're unlisted and these companies are growing, you're going to hold them for 3 or 4 years, possibly more. The critical thing, though, to understand is to make sure you maintain the tax benefits. You must hold them for 3 years. Now, of course, you can sell your shares if the company exits within 3 years, and that's a very nice problem to have because the company's done very well. But you need to hold for 3 years to make sure you maintain the tax benefits.
Interesting market. Charles, look, thanks indeed for dropping by to explain the EIS in some more detail. Charles Owen, there's a founder and director at Co-Investor.